Hello, welcome back. Good day. This is Seewing Yi, and today I'm going to go over another video. And this time it will be a mid-year 2023 housing forecast revised update by NAR, otherwise known as National Association of Realtors. So without further ado, I'm going to share my screen. Before I do that, please, toward the end of this video, share, like my video and subscribe to my YouTube channel, and also subscribe to our email newsletter on my website below so you can become a free member of our real estate investing community. All right, without further ado, let's go over this very recent information just came out on this mid-July National Housing and Economic Forecast 2023 mid-year update. Despite easing, home prices costs remain high. All right, so the highlight of this article is just that the revised information is that NAR, they changed their updates to show they are saying that the mortgage rate could, by the end of this year, 2023, will be around 6%, which is very good news. And they also revised their NAR home price forecast from growth to decline with a modest 0.6% slip for 2023 as a whole. In other words, they do not expect any kind of price gain for the calendar year 2023, not increasing, not decreasing, even decline to a modest less than 1% decline, which does not move a needle whatsoever, in my opinion. So, which is good. Stabilization and market stabilizing correction. As far as I'm concerned, the signs are pretty positive. My glass is always half full as opposed to a lot of those doom and gloomers out there who have this glass half empty belief system. Furthermore, this article goes to say that there's a total of roughly the projection by NAR is such that the home sales are still expected to register lower with a decline of 15.8% for 2023. This would mean a total of roughly 4.2 million homes sale for this year, the smallest annual total since 2012. If the projection is true, the end of this year, we will only have 4.2 million home sales seasonally adjusted. That will be the lowest on record past 11 years, 12. So mortgage rate lock-in has been a stronger factor than initially expected, and the number of homes for sale have not met initial projections. As a result, we have revised inventory change from growth to a moderate slip of 5% for the year as a whole, as early year gains give away to later year grind. 2022 right here is a historical data that transpire, and these are the numbers. And then Realtor, the initial 2023 forecast early this year showed this number. And now, as of today, the mid-year revised forecast by Realtor.com shows the following numbers. Here it is. The average 6.4% mortgage rate throughout the year, which right now this is around 7.12%, according to Mortgage News Daily. So the mortgage rate has elevated to 7.12% for those with excellent credit. However, hopefully no one would have a crystal ball, not even Realtor.com. So they are saying that at the end of this year, the mortgage rate go down 1 percentage point perhaps to 6.1% by the end of the year. If that's the case, then these are very positive spend projection for the rest of this year. Could be a good sign. Existing homes, medium quarter sales has been more loss on this mid-year revised projection. However, existing home sales is down 15.8%. down to 4.2 million. Their initial projection year over year at the beginning of the year was minus 14.1% and 4.5 million potential home sales. Okay. And existing home for sale inventory will continue to slide based on the projection of 5%. And the forecast at the beginning of the year for Realtor.com was very much wrong. They have an increase of 22.8%. Their projection or prediction are quite inaccurate in terms of existing home sale inventory. Single family home minus 19.6%, which is 0.8 million. Single family homes, which is very low inventory. And rate change, a slight decrease. So again, the housing forecast 2023 mid-year is very modest decrease in terms of home price cooling down. Our mortgage rate, 6.1% by the end of this year. We'll see. And the home sales are to be minus 15.8% as we stated. So let's go over the economic landscape. Inflation increases very gradually. The Federal Reserve are targeting ultimately a 2% inflation rate. That is their target. So there's a very tall order, very ambitious projection by the Federal Reserve. Right now, we are still up according to the government's CPI, Consumer Price Index, was up 4.9%. So there's a big gap between 4.9% inflation rate with the government CPI versus the goal of 2% inflation rate. So we have a long way to go. But we all know that the government's official inflation rate 4.9 is quite optimistic. But for us real consumers out there, when we look at our grocery bills and other consumer items that we are able to sell, we could make the argument that someone will feel as ordinary consumers out there, at least I feel that way, that the inflation rate is probably at least 8 to 10%, sometimes even higher, because our purchasing power is eating up by high inflation these days. So it'll be a while, in my projection, that the 2% inflation rate can be reached by any time, which the Federal Reserve and the infamous Jerome Powell, the chairman, anticipate. So what he's trying to do, they're trying to slow down the economy. The Federal Reserve wants to see unemployment higher. They want to see a slowdown of the job market, and so they could continue to meet their goal of 2% inflation rate. However, the job market is still very strong. There's a lot of jobs out there. Unemployment rate is very low. That's why we are having a higher mortgage rate, because mortgage rate are directly have a correlation with the 10-year treasury, and a 10-year treasury does not like to see good job data. As a result, the 10-year treasury has gone down lower, therefore impacting the mortgage rate. So that's why we see a very elevated around 7% mortgage rate, which between now and the end of this year, we could have anywhere mortgage rate could even be higher than 7.2, but not that much higher in my projection. But most likely for the remaining 5 to 6 months of this year, 2023, who knows, 6.5% mortgage rate to 7%. That would be the range. Only time will tell. The economy, the labor market continue to grow. Like I said, the labor market has outperformed expectations in 2023, kicking off the year with a blockbuster 500,000 jobs added and long-term low unemployment in January. That's why the mortgage rate is so high, because sanctions are not getting any lower, and the mortgage rate has been elevated as a result. Like I said, the unemployment rate remained at just 3.7%. However, consumers' paychecks are still not keeping up with inflation. As a result, the households are at a trajectory to deplete their savings the resources moving into 2024. Household wages increase have not kept up with the inflation increase. So that put the consumer spending at a very challenging position. 2023 housing trends, annual home sale trend. In 2022, home sales started the year last year above 6.5 million sales. However, that was before the mortgage rate surged in July of 2022. Therefore, the home sales plummeted. The home mortgage demand plummeted late last year. And end result was the home sale ending up at a 4 million sales pace for 2022 instead of projection of 6.5 million home sales. And the mortgage lock-in cost inventory to stall, we have been hearing, because of the lock-in effect of existing mortgage homeowners is creating a historic low undersupply of home inventory for sale, and the pent-up demand is still very elevated. Economics 101, when demand are greater than supply, as in this case right now, home prices get higher. As we have seen year to date, 2023, we have seen approximately 10% rise in medium sales prices year over year nationwide, although each local areas are different. Real estate is hyper local. In a emerging market reacts differently than another market or even another neighborhood, another zip code, even not necessarily, not only national. Home prices are still high because of the, like I said, high demand and low supply. More than 4 in 5 home shoppers, 82%, for feeling locked in effect, because 1 in 7 homeowners choose not to sell because they have a lock-in rate of 8%. Why should they move up to buy a new home and pay 7% rate, which essentially will at least double their mortgage payment? Those who have a very low, historical low rate, they are locked in. They're not willing to sell. They're sitting pretty on their low mortgage payments. Home prices not hit a new 2023 high. The relative strength of home prices in 2023 has been the bigger surprise for most analysts. You watch or listen to the Crash Bros, Crash Corn YouTube videos out there. The sky is falling. The housing crash has occurred. That was 2022 last year. Sorry to disappoint those Crash Bros out there. Home prices did not crash for the year 2022, even with the skyrocketing mortgage interest rate from 3% to 7.2% last November 2022, because of the historic low inventory and the lock-in effect of those mortgage homeowners. All right. So a lot of surprises out there, right? A lot of confusion. Sales prices have declined nationally, but this is largely driven by what's happening in the West, meaning the Western regions have seen declining housing prices for the second half of 2022 because of the volatility and the cyclical nature of the Western region. However, in other regions, home prices have either held steadily or continued to grow. Meaning, if you look at the Northeast, the Midwest, and the Southeast, we have seen homes are either stabilized or increasing in value, even late last year with a higher mortgage rate, believe it or not. So, yeah, the trophy markets, if you will, the Western region, Boise, Idaho, typical boom to bust towns, Phoenix, Arizona, Las Vegas, Austin, Texas, Boise, a few other places in the Western region, we've seen some skyrocketing home prices in 2021 that cannot sustain itself. So a lot of these boom town became at least temporarily bust town for the second half of 2022. But having said that, year to date, those boom to bust towns have recovered because the inventory is so low. We are seeing bidding wars in multiple offers, 3 to 5 offers per house so far this year. So we have some increased prices, double digit, go figure, and amid historically low inventory. So a lot of markets are recovering, correcting pretty quickly. However, because of our seasonality, as we move into the fall of this year, 2023, we expect home prices to moderate because there will be less transactions because of that's how it is every full semester. We have less transactions because of the holidays and what have you. People already set for the year, school and everything else for their children. All right. So finally, let's fast forward down here in terms of rent because of demand for rental properties is expected to remain strong throughout the rest of this year because we have 40-year home affordability. A lot of people are sitting in the sidelines because past few years, home prices have skyrocketed at least 40% past 2 years. And the mortgage rate has increased as well. So that creates a tremendous amount of people cannot afford to buy a home. So they are continuing to become a renter. However, there's a shortage of homes for rent and a shortage for homes to buy. So we are at a very abnormal market, if you will. So moving forward for the rest of this year, again, the mortgage rate stay between 6.5% to 7%. We'll see a stabilization of home prices. We already have increased 10% year over year, 6 months this year. Obviously, home prices not going to continue to increase. Unless the mortgage rate suddenly drop to 5%, then maybe we have a housing frenzy because that'll unlock a lot of people on the sidelines and the affordability start to occur because of lower mortgage rate. But until then, I do not expect to have a sudden housing frenzy because the mortgage rate will be still elevated between 6.5% to 7% again this year. But things are heating up, I believe. We still have a lot of buyers out there. There's a lot of buyers who may not need mortgages to buy. We could have 20% of the potential homeowners out there, prospective homeowners, have money to pay all cash, believe it or not. That's a lot of money coming into real estate, regardless of the challenging housing market. So a lot of people have still qualified. They have 20% down payment. So they're very motivated to buy. This is a new normal. They settle in. They no longer have a sticker shock with the mortgage rate. The psychological shock has subsided, meaning the sudden elevation in mortgage rate occurred last summer and fall has subsided. People understand to accept the new mortgage rate now, 6 to 7%. And we still have more potential buyers out there than there are available limited amount of inventories available out there. In my estimation, we're not going to see home price decreases. Maybe a small pockets of the Western region may still see a slight decrease in home prices. However, many markets in the South and Southeast and Midwest, home prices are still very stable. And in many submarkets, especially in Florida and Texas, in many suburban have seen home prices consistently increase in those markets because the homes already are fairly affordable in those submarkets. And many of those submarkets, as we speak, for our investors, they're buying cash flow properties in those submarkets. Very low price, good rent to price ratio. So anyway, that's all I have to say. So this, to recap, or we are going through a housing correction and stabilization. Housing to be flattening. We're still seeing demand out there. Therefore, more housing crash. The question is almost over. And some people even say the bottom of the housing market has already occurred at the beginning of this year. The bottom has happened. So the housing market will have no place to go but up. That's a lot of people's prediction, including myself. That's all I have to say. And just carry on. And if you see a lot of values in this presentation, please smash the like button and subscribe to my YouTube channel because I need a lot of subscribers out there, so I can provide weekly contents about the pulse of the housing market. Plus, I also discuss about the real estate investing markets. Having said that, if you have not already done so, please drop your email into our website below so you can become a member of our real estate investing community. Once you become a free member, you will receive weekly updates on your email about real estate investing opportunities, continuing education, about real estate investing and what have you. All right. And also, please drop a comment where you are listening to this video from. What's going on with your market, with your specific market? Or are you getting multiple offers, bidding wars out there? Tell me what's the pulse of your specific market because every market is very different. And also, what are you trying to do? Are you trying to buy a primary home or are you trying to become a real estate investor? Or where are you investing in terms of into properties. Share with me your specific situation. I'm very curious to hear because I'm very well versed into the South and Southeast market and the Midwest. We have investors, mom and pop investors buying cash flow homes at very cheap prices. Many fast growing markets, Florida and Texas, Alabama, and few other Midwest markets that we have investors buying turnkey cash flow homes. So our community is doing very well. All right. So be a part of our listing investing community and subscribe your email to our website. You will hopefully become a great real estate investor so achieve generation wealth for yourself and your family. All right. That's all I have to say. Thank you for attending. We appreciate you to be a member of our YouTube channel. Thank you so much. This is Seewing. I will see you in the next video. Have a nice day. Bye-bye.